Hey, this is Chris from StockSpot. Now, in Australia, the RBA, the Reserve Bank, has recently cut interest rates a couple of times and is expected to cut a couple more times at least before the end of the year. And something I learned recently is some banks automatically pass on lower interest rates by resetting your mortgage repayment to that lower interest, whereas some banks actually, by default, will make you continue to pay your previous amount unless you actually request for a reduction. So I wanted to cover in this video whether you should be asking your bank for a reduction if they haven't offered it, and what are some of the pros and cons of either paying the higher amount or rebasing it lower so you can invest the difference. Now let's use a real example here. Now in New South Wales at the moment, which is where I am, the average mortgage size is about $810,000. And so if the RBA cuts by 1%, which is what is expected to do this year, and you continue to pay the higher interest rate, then what you're effectively doing is paying another $8,100 per year towards your mortgage, which means that over a 25-year period, based on the current interest rate of somewhere between 5.5% to 6%, which is what a lot of people are paying, you'll save interest of about $200,000 or a little bit over. So that's the benefit if you continue to pay the higher amount. On the flip side, your other option is actually to pay the lower amount, so actually rebase your mortgage repayment to the current prevailing interest rates and actually take the difference and invest it. So if you do that for 25 years, you invest that $8,100 every year into a diversified portfolio, and it returns something like the historical average of about 8% per year, then you'll be better off by just over $600,000 over that same period. The caveat with that, of course, is that that's a pre-tax number, and your after-tax amount is going to be a bit lower than that, depending on your marginal tax rate, because you'll be paying some tax both on the income you're earning over that period and also the capital gains that you make in the end. But even after the tax is accounted for, you're likely over a long period of time, based on the current prevailing interest rates versus investment returns, to be better off investing versus leaving it in your mortgage.
Sorry for interrupting, but I'd like to take a moment to talk about my channel. Now, most people who watch my videos don't subscribe to my channel, which means that they don't find out about other videos I'm making, and it doesn't share the love with others who are interested in investing. So if you are interested in videos like this, I would encourage you to please subscribe to my channel so you find out more about the videos we're making here.
So now I'm going to look at actually why you might want to consider one over the other. So what's the right choice? Well, definitely leaving the money in the mortgage account and actually overpaying is a sensible option. It means that you're going to be paying off your mortgage quicker, you're going to be reducing your interest burden, and you're going to be in a better financial position because of it. The disadvantages of this strategy is that you're not really diversifying your wealth and savings outside of that single asset, which is your property, and so you're missing out potentially on returns from other investments like shares and bonds and gold that you could be accessing otherwise, which is of course the benefit of investing, which is that as well as owning your house, you're actually diversifying and owning other types of investments that may do better at different times of the economic cycle. So you might have a period where your property doesn't perform so well, but your outside investments are doing better, and vice versa, where your house is doing very well and the investments are not doing quite as well. So there's pros and cons, I think, of each. Really, it's up to your individual circumstances, but some of the factors I think I would be considering is how stable is your income, first of all, because if you have a stable income, you're in a better position to be able to diversify outside of your mortgage because you know that you're going to be able to continue to make your mortgage repayments. If you don't have a stable income, or you're worried about changing jobs or that your income may fall, you may want to be building up a bigger buffer in your mortgage to really make sure that you can cover the difference if the circumstances in your life change. So that's the first factor. The next one is, can you be leaving the money invested for at least 5 years? For stock spot investments that are either balanced or growth or high growth, we're recommending at least a 5-year time horizon to make sure that you can actually earn the market return and you're not going to be washed around by market volatility. If you are considering investing in markets, make sure your time horizon at least is 5 years. Otherwise, you're really too exposed to the market noise and the ups and downs of the market cycle. And then the final thing I'd be considering is how comfortable are you with market movements? When you own your property, you don't really see the price move up and down every week, and so you don't really have to worry about market ups and downs. With an investment portfolio, look, as long as your time horizon is long enough, you also don't need to worry about it, but there's a temptation to check your portfolio often. And if you're the sort of person that gets nervous when you see markets go up and down and it impacts your portfolio balance, then investing might not be right for you. But if you are comfortable with that, then of course it might be an option you want to consider. So there's some of the factors I'd be thinking about when considering whether to use some of these lower mortgage repayments we're seeing at the moment in Australia to invest, or whether to instead plonk more into your mortgage to pay it off earlier. At StockSpot, we're already helping thousands of people who are saving in this sort of way and saving for other goals. It's one of the most common questions we're getting at the moment is investing your mortgage offset account or thinking whether to put more in your mortgage or invest. So if you are considering it, you can come to our website, stockspot.com.au, and find out which portfolio we'd recommend for you. For a lot of these types of investors, we're recommending typically a balanced growth or high growth option. And if you like this video and found it helpful, please give it a like and subscribe, and have a look at some of the other videos I've made about helping you learn about investing and saving up for long-term goals.